Today I would like to analyze Ulta Beauty, one of the largest beauty retailer in the United States. Warren Buffett, Berkshire Hathaway just sold their position in this company. This company has a good performance in the last 5 years, is up around 68%, but in the last 2 years the performance was quite bad. We are down around 28%. So we're going to take a look at the financials to find out if it's a good buy right now. The first thing we can recognize is a market cap of 17.47 billion US dollar. This makes Ulta Beauty the 8th largest beauty company in the world by the market cap. Now we're going to take a look at the financials. The first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business and not a declining business. In 2021, the revenue was around 6.15 billion US dollar. This was a 16% decrease from 2020, so probably related to COVID. In 2022, we saw the strong increase around 40%. This is something we like to see. In 2023, around 18% increase. This is also very good. And in 2024, we saw the good growth around 10%. So we like to see that this company has a good revenue growth in the last 5 years. So the check here. The next thing we're looking for is free cash flow growth in the last 5 years. The free cash flow is very important because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So in 2021, the free cash flow was around 0.66 billion US dollar. This was a 17% decrease from 2020, so probably related to COVID. In 2022, we saw the strong comeback with a growth around 34%. This is something we like to see. In 2023, we saw the strong growth again around 31%. This is very good. And then in 2024, we saw the decline around 11%. But again, we had 2 years in a row with an incredible growth. So I would still say in the last 5 years is a good free cash flow growth. So it's a check here. If we take a look at the operating cash flow, we can see we had a small decline around 0.38% in 2024. So the reason for the high free cash flow decline in 2024 is mostly the higher capital expenditures. We can see this company spent around 130 million more in 2024. So this company invested more money into the business. The next thing we're looking for is a free cash flow yield over 4%. So this can also tell us about the valuation of this company. The higher the free cash flow yield, the higher the indication for undervaluation. So we want to see a high free cash flow yield. So in 2024, the free cash flow was around 1.04 billion US dollar. So we're going to take this number. We're going to divide it with the current market cap, 17.47 billion. Then we're going to get the free cash flow yield for 2024. So the number we're going to get would be around 5.95%. So this is a great free cash flow yield actually. It's quite high, it's over 4%, and it's a check here, we like to see that. But we should also take a look at the future assumptions about the free cash flow. If we ask ChatGPT, we can see here in 2025 the free cash flow could be around 964 million US dollar, in 2026 around 860 million US dollar, and in 2027 around 900 million US dollar. So let's assume for 2027 we can reach around 900 million. So we're going to take this number, we're going to divide it with the current market cap, 17.47 billion. Then we're going to get the free cash flow yield for 2027. So let me know in the comment section if you think this number is realistic. Then we would get a free cash flow yield of 5.15%. And that's still quite good actually. I think it's over 4%. So I think this free cash flow yield is still good. And this could still be an indication for undervaluation. The next thing we're looking for is a debt to free cash flow ratio under 5. This means the company can repay the debt with a free cash flow in under 5 years. A very important number, because if the company has too much debt and cannot repay the debt, it can risk to go bankrupt. So first we're going to take a look at the long-term debt. So long-term debt is here around 1.64 billion US dollar. We're going to take a look at the short-term debt as well. We can see here 0.29 billion US dollar. Then we're going to divide it with the current free cash flow, 1.04 billion. And then we're going to get the debt to free cash flow ratio that we're looking for. So the number we're going to get would be around 1.85. So this is a great number actually. It means a little bit under 2 years we can repay the debt with the free cash flow. So we like to see that. It's a good number and a check here. We can also take a look at the cash on hand, how much money this company has in the bank. So we can see here cash and short-term investment are around 0.7 billion US dollar. And I think this is also a great amount actually. So this company has a lot of money in the bank. We like to see that. So I think this company has a great balance sheet and that's a very good thing. Now we would like to see the enterprise valuation to free cash flow ratio under 25. So this can also tell us about the valuation of this company. The lower the number gets, the higher the indication for undervaluation. So we want to see a low number here. First, we're going to calculate the enterprise valuation. The current market cap, 17.47 billion. We're going to add the debt. So the debt is around 1.93 billion. We're going to take minus the cash. The cash was around 0.7 billion. So this is then their enterprise valuation for the company, how much the whole company is worth. So the number we're going to get would be around 18.7 billion. So now we're going to divide it with the current free cash flow first. This is 1.04 billion. The number we're going to get would be around 17.98. And that's a great number actually. It's an indication for undervaluation is under 25. So we like to see that as a check here. We can also calculate this number with the free cash flow assumptions for 2027. So this number would look worse than. So the number we're gonna get would be around 20.77. Still a good number, I would say. So if you believe in this company, I think it's a fair valuation or even an undervaluation right now. The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. We like to see that, especially we think the company is undervalued. So we're going to take a look and we can see here, yes, this company does a lot of buybacks. This is actually great. We can see sometimes over 3%, 2%, and in 2022 over 5%. These are very high numbers. And I think this can help the stock price to increase as well. And I think this company can also afford it as well. They have a good balance sheet. And it's a check here for me is something we really like to see. Is Ulta Beauty stock a good buy at the moment? So let's start with a positive. So we had a good revenue growth in the last 5 years. We also had a good free cash flow growth as well. This is something we like to see. The balance sheet is also looking great. We have a low amount of debt and a good amount of cash on hand. The free cash flow yield around 5.95% is also looking very good. It's a high free cash flow yield. This could be an indication for undervaluation. With our free cash flow assumptions for 2027, the free cash flow yield would be around 5.15%, which is still looking good. Our enterprise valuation to free cash flow ratio around 17.98 is also an indication for undervaluation. Even with our free cash flow assumptions for 2027, this number would still look quite good, around 20.77. And this company also has a lot of buybacks, so they're buying back their own stocks, and this can help the stock price to increase as well. So I think this company looks very interesting now. If you believe in this company long term, I think it can be a good buy. If you found this video helpful, don't forget to like and comment and subscribe for more content.